Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, April 3rd, 2021. And our top story this week, we'll take a look at pension systems in the developing world. Well, joining me now to discuss this and a lot more is Seda Peksevem. She's a PhD candidate and researcher at Boğaziçi University in Istanbul, Turkey. Seda, it is great to see you. Thanks so much for joining us on the program this morning.
Thank you so much for the invitation, Jeff. How are you?
I'm doing quite well, and I'm excited to talk to you because you authored a paper, which I read, most of it I understood, but you authored a paper on aging and the impact of aging in developing countries versus, developed countries. So let's start there. Are there some differences? Are there some comparisons to what we have here in the West versus some of these developed countries?
Of course. Well, Jeff, indeed, global trend, aging phenomena exists for almost every country. It's okay, but its impact is not equal for every region. So developing regions will certainly age considerably faster than developed ones. And to mitigate this situation for retirement systems, they are trying to struggle with reducing public pension systems and then private, but I think we can discuss this later. So I can give some number about illustrating the aging trends in developing countries and comparison with developed ones. Indeed, the demographic transition stage took over in some developed countries about 150 years. But in some developing countries, it took almost 25 years. So this means that developing countries will considerably aging faster than developed ones. And developed ones mainly discussed in the context of Spain, Italy, Germany, and Japan. But in South Korea, the speed of the aging is the highest, and old age dependency ratios is projected to increase more than tripled by 2050. So developing countries should be quickly adapted to this new aging trend than developed ones.
Yeah, and I mean, this is absolutely fascinating. And, you know, our network focuses on looks through the lens of retirement. And this has an impact on retirement systems, doesn't it? Obviously, if you have an aging population and you're not replenishing that, if for lack of a better term, you don't have a high fertility rate, which we don't have here in the US, and China, I think, has a low fertility rate. This is going to impact your retirement system and what the standard of living will be for retirees. How do you see it?
Jeff, from the government's perspective, the aging trend will further deteriorate the sustainability and adequacy of public pensions. Now, governments have to face with increasing public costs, and when it comes to retirees, they will have to settle for a lower standard of living, which means in the retirement language, lower adequacy ratios, lower replacement rates. When we look at the replacement rates in developing regions, we can see that most of them will have replacement rates below 40% in the near future. This is the minimum ratio defined by the International Labour Organization to protect old age poverty. And this means that most developing countries seem to encounter very difficulties to get the fine balancing between sustainability and adequacy of public pensions. So, and also on the other side, some other developing countries have higher replacement rates like India, Indonesia, Turkey. But these countries have also allowed very early retirement ages in the past. For example, I can give an extreme example to you. In Brazil, I think in 1990s, civil servants had some permission to get their 80% of retirement benefits, staying in the system only in 5 years. So this does not mean that always providing high replacement rates is an optimal, because this will induce higher burdens to the public budgets. And so in order to balance this two functions of public pension systems, developing countries will further struggle with the situation, I think.
Yeah, and the reality is we're all living longer. The less you have for retirement and the longer you live, that really dilutes your retirement income. That dilutes the amount of money you're going to have for that longer life. And as you know from doing your research, Healthcare expenses, at least here in the States, and I'm curious to know what it is in some of these developing countries, those expenses go up in retirement. That is probably the number one expense for people once they hit their retirement age. So the longer you have with less money really is going to set you back, I think, from the standard of living. But curious to get your insight.
In terms of, yes, you are right. We are living longer and standard of living will decrease, unfortunately. But my main argument is that here, emerging market countries should definitely quickly adapt to this reality by removing their pension systems from public to private pensions. Because government pension spending, I think, consists from 1 to 5 ratio of total public spending in emerging market countries. So this is a huge number. And they have to really shift from public to private pension systems to deal with the situation. Because if they want to give much more benefits to their retirees, they have to increase the public costs of pensions. But if they want to reduce their retirement benefits, they have to also, they can decrease their public costs. But this balance is not sustainable for any country. If you want to go with this, you need to have low coverage rates in your public pension systems, such as some South Asian and South African countries. So there is no country that can find a fine balance between sustainability, adequacy, and coverage.
Yeah, and when it comes down to it, the numbers are the numbers. You just can't change the facts around the demographics and the statistics.
Yeah.
Seda, let's talk about ways to improve the system. I know you in the paper you discuss features like auto enrollment, behavioral finance, or what we call here in the States is behavioral finance. What are some of the solutions that you're looking at that you identified in your paper that governments, whether, quite frankly, whether in their developed countries or developing countries, what can they do to make their retirement better for their citizens?
Well, Jeff, indeed, before coming to the auto enrollment policy, because it was also introduced by emerging markets, developing countries, I want to tell you that indeed emerging market pension systems have already introduced some traditional policies, such as tax advantage, financial incentives, financial education programs. But when we look at the situation, emerging market pensions still have very limited pension savings. So they, in the last 5 years, I think, 5 emerging market countries also introduced auto-enrollment programs. Chile, Turkey, my country, and 3 Central Eastern European countries, Lithuania, Poland, and Georgia. But when we look at the features of these auto-enrollment programs, they are not much different than those in developed countries such as US, UK, and New Zealand. But opt-out rates are really high and above about 60%. So these opt-out rates are really high compared to the experiences of developed countries where the opt-out rates are below about 15%. So I think auto-enrollment policy is not a lifeboat for emerging market pension systems, and they need further solutions to promote retirement savings. And they need to incorporate behavioral and technological solutions because these countries have high share of low income and informal population, which is a barrier in achieving high participation rates in auto-enrollment. So in behavioral and technological solutions, I want to mention 2 initiatives indeed. The first one is saving through consumption platforms. In these platforms, which I think very suitable to low income and irregular income people, a certain amount of your consumption is transferred to your savings account. And via your consumption, you can save a sizable amount after 40 years. So these platforms are available in Spain, Mexico, and Australia. And indeed, they are really successful. And the second initiative, I can say, again, the incorporation with behavioral and technological solutions is the digital micro-pensions. With the accelerating speed of the fintech solutions, these digital micro-pensions apps allow people to make small contributions at daily or weekly frequencies. Because as we know, low income and irregular informal population are more inclined to make small contributions with daily or weekly frequencies rather than monthly payments, such as most private pension plans deducted from our salaries. So for these kind of people, low-income and informally employed groups, to promote retirement savings, emerging market pension systems need to incorporate technological and behavioral solutions in it, Jeff.
Yeah, Seda, I guess last question, based on these solutions that you suggest, and I'm sure this is stuff these are things and concepts that we have been talking about for a while, but do you think governments, both developed and developing countries, are listening or taking notice and saying it's going to be a comprehensive effort? It's going to take automatic enrollment, it's going to take auto features, it's going to take technology, and it's going to take modifying behavior. Is this at the top of their list or at the top of the list for governments around the world in terms of helping their citizens?
Indeed, I'm surprising that, for example, in saving through consumption platforms, developing countries has made the recent further step than developed ones. For example, as I said you before, in Spain and Mexico, they introduced these kinds of saving through consumption apps. Also, I think China is introducing this kind of app. And when you make some purchases from eBay or Amazon, some of their purchases will be transferred to your savings accounts. And also, yes, governments are really considering this situation and try to promote retirement savings among people's life. But we need to consider that developing and developed countries are very different. They have some structural differences that couldn't be mitigated. And for example, mitigated with poverty and informal population needs long-term solutions. But emerging markets, due to the rapid aging trend, need to promote retirement savings in a much more quick way, Jeff. So I think governments need to or should consider these technological and behavioral solutions. And especially in developing countries, they are making some efforts with third parties, pension funds, merchants, retailers, to accelerate the trend of these saving through consumption platforms and digital micropensions.
Well, let's hope that they read your paper, they watch the show, and they really take some action. Seda Peksevim, thank you so much for joining us on the program this morning.
Thanks for having me, Jeff.
It's having you back again very soon. Thank you.
Thank you so much.
Thanks, Seda. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Monday, I sat down with the City of Havre de Grace's Shane Grimm to learn about how small cities are preparing for the migration from large cities. Let's take a look.
Correct. Yeah, I'm working towards my master's degree. Lots of work there, but yes, zoning is a passion of mine. I've been in the field for about 20 years. Started out at the county level and came to the City of Havre de Grace about 3 years ago, and I really love the municipal side of planning. Well, I think anyone would say we would never want to have a situation like COVID, but if there were any benefits for the City of Havre de Grace because of COVID, is that people are now looking at moving out of larger cities or larger urban areas to smaller urban areas, and Havre de Grace is really benefiting from that. We're seeing a real uptick in new development and also in what I call infill development in our older downtown areas where there are either vacant lots that have been there for a while or demolitions and new construction. But we're seeing a real influx of people, especially from New York, New Jersey, those areas, coming down to Havre de Grace and either having another new home or a vacation home. But certainly people are really moving out of those cities and trying to find cities like Havre de Grace that are quaint, offer a lot of attractions and amenities. And we have that in spades. So it is really a great time for us as far as moving forward out of COVID. Well, that's a great point and great question. So the city has really experienced this exponential growth or infill growth in town that is really driving up the price of new homes and renovations. And what we have seen in the city is a number of renovations that really have kind of surprised us. And they are renovations of older homes, 1800s homes that now are bringing anywhere from $600,000 to $900,000 in certain areas of town. And so we've been really impressed. So the home prices have increased exponentially and just in the last year. And as far as values, property values in this region, the assessed values for residential properties has gone up by 8%, and commercial property values have gone up by 2%. So we're really seeing that. We're seeing prices go up. But you're correct, there is a lot of pressure, and we have been actively going out with our Department of Public Works and replacing old sewer lines. Unfortunately, like a lot of cities, we still have some water lines that date back to the Teddy Roosevelt administration. You wouldn't believe that, but in a lot of places, people are served by infrastructure that is well over 100 years old. So we deal with that challenge of having to replace that and the costs that go along with that. So it is a challenge, but right now we're growing within our boundaries. We're not growing outside as much. So it's really an exciting time for the city, and we have so many attractive amenities here, a brand new middle high school, and just so many things going on that are really bringing those people and driving up those prices. No, unfortunately, our hospital, we have an older hospital that was supposed to relocate within town. Unfortunately, it is relocating to Aberdeen, which while we're disappointed that it is leaving, in fact, it's only 5 miles away. And the unfortunate part is we're losing a hospital, but we were going to be losing a hospital anyways, even if it stayed in town, because they were no longer going to be a full-scale hospital. They were going to be called what is a freestanding medical facility. Mm-hmm. So they don't have all the services of a typical hospital. So in some sense, we were losing a hospital anyway. Yes, and if you're ever in town, speaking of bakeries, you need to try Gall's Bakery, which has been in town for over 100 years. And I think they even use the same equipment to make cookies that they did 100 years ago. So try that. But no, we're
good plug, Shane.
We're very excited for our first brewery in town, which will be opening up in a couple of weeks. I worked actively with them and prior to them to try to have regulations that encourage and incentivize those businesses to be able to come in easily and slip into downtown, and that's what we're doing. One of the things that we've needed for a long time, which I may have spoke about on the last episode I was on, is we're really kind of desperate for a hotel, or what I call a boutique hotel. And I'm really hopeful we have a unique opportunity with several parcels on the waterfront that if they can be combined, we're very hopeful that they'll consider some type of mixed use development that incorporates a hotel, at least a mid to high end hotel that would accommodate all of the events that we have and weddings. We're a big town for weddings, but we've also had new restaurants open up. We have a new restaurant on the north end of town, which is exciting. So it's all good stuff going on here. Yes, that's always a challenge, and especially in this day and age, keeping your police force and trying to get new recruits to come in. So that's a challenge that we always face every day here. We always have either people are retiring and trying to bring in new police force members. Same thing with the fire department and all. It's not the same as it was, say, 30 or 40 years ago, where there were more people active in those organizations. But yes, with the influx of people, we definitely need to reevaluate our services regularly to make sure that we can provide them. Luckily, our fire department is one of the best in the nation with response times for a city of this size. So we're very lucky there. But it is definitely a challenge, and any city knows that keeping up with infrastructure and those services, it can be a challenge, especially in these times.
And on Thursday, I sat down with the Reason Foundation's Rod Crean and Rich Hiller to rethink public employees' retirement plans. Let's take a look.
It's a great question, Jeff, because unfortunately, I think that in a lot of cases has become the choice. Either it's a traditional DB as it's been known for decades, or it's a typical 401k style DC plan, which, as we know, was not ever designed to be a primary retirement plan. And this binary choice, unfortunately, in many cases, leads to inaction in terms of real reform, because you say, both ends of this spectrum have significant issues when trying to be used as a primary retirement plan for the modern workforce. The answers really lie in some type of mixture, if you will, and taking the best aspects from DB and the best aspects from DC and making them work together to meet, again, employee needs, employer needs, and recognizing the taxpayer issues as well.
Well, I don't know if it's all of this is unique, but because there have been some really interesting ideas and out there that do marry together some of the best aspects of defined benefit and defined contribution that exists right now. We think that there can be more to that. But if you kind of tick off the attributes, what are we actually looking for? What are the things that make DB plans so attractive? That's the fact that we've got to focus on retirement income. That's fundamentally what they do. It's a retirement income for life. So longevity is something that you don't worry about when you're in the DB plan, because that payment comes every month. The certainty of the benefit is also something that we want and like to take from the DB world and see what we can do with here. The fact that investments are handled by professionals who have a singular goal here is something that we want to bring into the new solution set. And we like the fact that we can get disability and death benefits from pension plans as well. So grab all that, and then you go to the defined contribution side. And what are the great things there? Well, one of the things that DB plans do horribly is that we talked about it earlier is you don't have a portable benefit. If you leave and you're not vested, or you're a short service individual, your benefit is worth nothing or not very much when you ultimately retire 30 or 40 years from now. So benefit portability is a hallmark attribute of defined contribution. We want to keep that if we can. We love the fact that in this day and age that DC plans don't add new unfunded liabilities for the employers. So that's one of the things you hear all the time by public policymakers. And then the fact that it's flexible. It's flexible in a number of different ways. One of the problems in the public sector is it's like once you have a DB plan, there's always a DB plan. You can never take it away. That California rule and the vesting side of benefits, something that ERISA doesn't even require for vesting in the corporate world. You can change something if the employer needs to change things, like changing work patterns. Well, we can't do that in the public sector with the DB plans. DC plans can do that. And then the ability to focus the investments on individuals rather than the average participant in the plan. Optimization of investment structures and to meet individuals' needs, whether they're married or not, whether they think they're going to live until 95, whether they've got dependents, taking into account inflationary concerns. All of these things we want to bring into the new designs, and that's where we think there's tools out there that we could be using that were not enough. Just some examples. Basically, and Rich has written a number of pieces on this. Is the group annuity world is not as bad as some people think. Some people say annuity and it's bad. Well, annuity products can solve some of these problems for DC plans. You don't have to have a DC plan that lets people retire and spend all their money on a $100,000 RV. You can make them annuitize. So a plan design can come into the equation and make a DC plan look and act more like a DB plan. And then probably one of the things that we want to focus on a lot is the ability to take more of those factors into account that may affect retirement security. Like we talked about, the inflation, healthcare costs, different levels of longevity that people experience, and allow the investment of their money to be more customized, so they get that greater probability, that greater certainty that DB plans still provide. So those are examples where existing tools exist and they're just not being coupled together in the right way. It's something that we really want these public sector policymakers and pension administration experts to start thinking about. How do we evolve these plans so they don't become dinosaurs?
Well, that's certainly a 60-second question, Jeff.
I was teeing it up as the teaser for when you guys come back.
I think there are some of those things do help. The Secure Act, I'd say in particular, because one of the things it's doing is allowing or really mandating the idea of lifetime income in DC. Getting people thinking that that a DC plan isn't just a savings plan, but certainly. There are more things that can be done from a regulatory perspective, but, as Rod was saying, a lot of things can be done without that, under existing regulations. And, one of the things that I think, and I know that you've spent a lot of time on, and that I think is really helping move towards solutions, is the technology available in the financial world today that wasn't there, a decade ago or so. And, allowing you to do things on an individual basis in a cost-effective way that before could only really be looked at a plan level. And those kind of things allow you, I think, to bring some DB-like qualities into, more of a DC foundation that allows for the mobility as well, but also keeps you focused on that retirement income need down the road. So, look forward to talking more about, what can be done going forward, Jeff.
And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our newsletter, The Morning Pulse, and of course, our website. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services. as we analyze the latest information this week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.